CrowdStrike is an amazing company in the cybersecurity sector. It's a stock that I actually used to own. I bought it in 2023 when we had the Silicon Valley Bank sell-off, and I bought it for decent valuations, and I sold it because it went up, and I just made a mistake. It was looking expensive, so I sold it. And since then, I've been wanting to get back in the company, and I just couldn't really pay up. I just couldn't pay up for the valuation. But now the stock is down 7%. I really want to get exposure to cybersecurity in my portfolio. I think with AI and cloud and all the things that are expanding for the future, cybersecurity is going to be very important, and CrowdStrike is a leader. Now the stock is down 7%. I'm going to talk about it, let you know my quick valuation model, my quick thoughts on the company. If I believe this dip is a buying opportunity, or maybe it's still a little bit expensive and we should wait for a lower price. I really hope you enjoy it as always. Now, most of you guys know how CrowdStrike makes their money, and the beautiful thing about the business model is like 98 or 99% is subscription-based revenue recurring, which is very efficient and high-margin stuff for the company. Over $1 billion is subscription, and only $50 million is professional services. And then they have very high 74% gross margins. So again, it's a very, very profitable business model for the company. But they have a lot going in operating expenses and research and development, sales and marketing, and those kind of cybersecurity stocks are extremely, extremely hard to value. Most of them are not profitable on a GAAP basis. They're just profitable on non-GAAP. And there's a lot of stock-based compensation. So they're very hard to value. And I'm going to do my best to value CrowdStrike in the video. AIR, annual recurring revenue, is up 23% year on year. Net new AIR was only up 6% quarter on quarter, indicating a potential slowdown or cool off in the cybersecurity space, or mainly in CrowdStrike, as there's a lot of competition. They are expanding. One of them is Zscaler. I analyzed it too. Revenue is up 25% year on year, $20 million beat. Non-GAAP earnings per share was $1.03, which was actually a 17-cent beat. So if everything looks so good, why is the stock going down? One of the reasons why the stock's going down is because they missed by over $1 on the estimates. So they got 333 to 345 in guidance. The estimates was $4.42. This is around a 98 cents to $1 miss. Massive, massive miss. But the main reason why they missed on that was because they changed some things within their non-GAAP accounting to account for 22.5% kind of taxes, and that would affect earnings per share for fiscal year 2026 around 98 cents. So this is why they missed it, because those changes in accounting measures, they affected their guidance by 98 cents, and that's why they missed on the estimates. And it wasn't too bad. So if it wasn't that changed happening, it would have met the $4.42, which indicate that the business model itself is still fine. In terms of cloud security, this is big for them, especially now with AI and a lot of things that's happening. Cloud security, cloud cybersecurity stuff is going to be huge. It's growing 45% year on year. Identity security is growing 20%. And they have many different things growing over 115% year on year. Again, cyber is very, very hot. And that's why I want to get exposure. But I want to make sure that I'm not overpaying for those stocks. Net retention over 112%. Again, amazing business model for the company. Now, we look at the valuation, and it's a little bit scary. It's trading at 88 times non-GAAP forward earnings. This is not really forward earnings, non-GAAP. It's trading at 88.5 times. This is really, really expensive. Or over 21 times forward sales on CrowdStrike. This is insane. I mean, when I bought the stock back in 2023, it was trading like 11, 12 times or so. Yeah, it was around 10, 11 times. I thought that was a little bit more fair. The PE was like 51 times. I'm like, okay, I can digest that. But now 21 times sales over pretty close to 100 times forward earnings. To me, it's just extremely, extremely, extremely expensive. And I'm going to tell you how I'm going to value the stock. For revenue growth, they're still growing revenues, although it's decelerating, expected to decelerate to 20%. And then they're going to grow 22% for the next 5 years. I believe this is achievable. This is fair, as you know, cybersecurity is hot. It is going to continue being hot for many years to come. So the company is going to benefit from that. Earnings per share is all over the place. They used to grow EPS 100%. This last year it was 27%. This year is going to be negative due to the adjustments in non-GAAP measures. Then next year is expected 43%, then 28 and 27. So I would, for me personally, I would be willing to bet around 25% earnings per share growth. Meaning, for revenues, if it grows 20, 22% and have some tiny margin expansion, I would expect 25% earnings per share growth over the next 5 years, which I personally believe is fair. Okay, now this is how I'm valuing CrowdStrike. I took the fiscal year 2026 estimate after the accounting measures of $3.45. Then 4 years after that, which would be a total of 5 years, I put in earnings per share growth of 25%, which again, I would not be willing to bet more than 25%. I think you guys can agree that that's fair for the company. Now, 5 years from now, I get an estimate of $8.42 in non-GAAP earnings per share. Now, this is the tricky part in terms of putting on a PE ratio for CrowdStrike. Normally, with growth companies in general, I like to pay pretty close to 1 times PEG ratio, so price to earnings growth. So if earnings are growing 25%, I like to pay a PE ratio of around 25 times earnings. If they're growing 50%, I believe they can continue growing 50%, I would be willing to pay 50 times earnings. But I have a rule in my book where no matter how amazing the company is, no matter how much I like the growth, no matter how hot the industry is, I would not be willing to pay more than a 2 PEG ratio, or more than twice the growth. So with CrowdStrike, if I believe they're going to grow 25 PE for many years to come, and it's unprofitable on a GAAP basis, and there's a lot of different things, I would not be willing to pay more than 50 times earnings. And I'm not willing to put in 85 PE 5 years from now. To me, that's extremely, extremely speculative with no margin of safety. Now, if I take the 842 and we put in on a 2 PEG ratio, which is, in my opinion, on the high end, 2 PEG ratio, that would be times 50 times earnings, I would get $421 per share on CrowdStrike 5 years from now. Now, if I'm trying to get a double on the company over the next 5 years, I would have to buy the stock right now around $210 per share. Now, $210 per share, it's really low. And I'm being honest, guys, I don't believe CrowdStrike is going back to $210 per share unless we have a major crash and something major happens. And I recognize that. So this is why on my own, price sheet on my own Yahoo Finance watch list, I have a price alert of $300 per share. Now, if CrowdStrike gets to $300 per share or below, to me, it would start getting interesting. I might look into the company a little bit more, decide if I want to pay up and dollar cost average down. But my fair value on the stock is around $220, maybe maximum $250. I know it's not going there. So again, for me personally, I would recommend looking at the stock below $300. If you're buying CrowdStrike right now, I think the stock is priced to perfection. Again, it could do amazingly well. It's very hot, cybersecurity, and the market can push the stock back up, and I could look like an idiot right now saying that the stock is worth 210. But that's what the numbers are telling me. The numbers don't lie. And if I buy the stock here, I would not be comfortable holding it, knowing that it's worth $210. So I put in a price alert at $300. If it goes below 300, then I might be interested in the company. But right now, at 21 times forward sales, I just can't pay up for the stock. So I hope you guys make money in cybersecurity. I want exposure, but I want to make sure to be disciplined and to pay the right price. So that's how I think about CrowdStrike. Not financial advice. Hope you enjoyed it. If you did enjoy it, please press the like button and maybe consider subscribing. So I'll talk to you in another video.